I'm a chartered accountant. We're now referred to as chartered professional accountants in Canada. I'm also a chartered business valuator. I've been a chartered accountant for over 30 years, and I've been a chartered business valuator for about 12 years now. Okay, so in the context of selling a business, getting a professional valuation done is a little bit akin to when you're selling a house and you get a property appraisal done ahead of time. It just helps to have a third party look at the business, take a completely independent look, because you as the owner manager might see things differently. So having an outside party look at it, I think, is always a good idea. Okay, so some of the common misconceptions that I hear when I'm talking to folks who are looking at selling their business is, and probably the overriding misconception, is that there's some kind of standard that can be applied to the business, a standard valuation multiple, and typically it's 3 times gross profit or 3 times net profit or something along those lines. Now, to be clear, those kind of metrics do work in some industries. Where you have industries that are where every business in that industry operates pretty much to a formula, those kind of valuation multiples are fairly standard. And a good example of that would be franchised restaurants, fast food restaurants. So in those cases, they all operate to a formula. They sell their meals for a set price. They know exactly what they're costing. They know what their labor is costing. And so it's fairly appropriate to use an industry standard multiple when you're selling that kind of business. However, for most businesses, there are sufficient variations within each industry that are specific to each business that may have a big impact on the value of the business and the price at which it can be sold. And to give you an example, let's take it's an HVAC business. So, heating, air conditioning, that type of thing, ventilation. It's a reasonably standard service that is being offered. However, every community is different. There could be a different number of competitors, a different level in the economy. And, typically in a very vibrant economy, people clean up their air conditioning and their heating and so on more than they would in a depressed environment. And so in those cases, the risks associated with each individual business can be very different from those in a big sample. And in those cases, applying a industry standard in order to figure out what the price should be can be quite misleading. It's not a bad way of checking a valuation once it is already done, but it can be misleading if it is used as the primary valuation method. That's the biggest misconception. Other misconceptions are, one big misconception is that the value that the valuator comes up with is the value at which it should be sold. And this, again, is similar to the property appraisal analysis or analogy. And what I mean by that is that A business valuator looks at a business and derives what he or she considers to be the fair market value of the business. When you're negotiating to sell the business, you're really negotiating for a price. And price and fair market value have a number of differences. Fair market value is a very theoretical concept. It assumes that there's a completely open market. You can sell to anybody on the planet. Now we know that that is not the case. There are usually a limited number of buyers in the market. It assumes that the buyer and the seller are both equally well informed. And we know that normally the seller is much better informed about the business than the buyer will be. And that's where the buyer really needs to do their due diligence to become as well informed about the business as the seller, if possible. It assumes fair market value, this notional idea, also assumes that nobody is in any particular hurry. There's no compelling reason why the person should sell or the person should buy. And in real life, that is also not true. Very often, people who are selling the business are selling because they want to retire, and they want to retire within a year or less time. Maybe there are health issues. Maybe they just want to move town. And so there's often very compelling reasons why people sell, and that can lead them to negotiate in a way that is different and arrives at a different result to what a fair market valuator might come up with. Similarly, with people looking to buy, there are often very compelling reasons why somebody wants to buy a business. And you can, anybody listening can figure that out. But that also means that they negotiate in a way that is not necessarily going to arrive at the same result as a business valuator might arrive at. Other issues that determine fair market value, there is an assumption that the whole purchase price would be paid all at once. And that is not always the case with a sale transaction. Often the seller has to be paid over a number of months or years, and that is not normally taken into account when determining fair market value. And the final reason that fair market value might not equal price is that very often, the fair market value assumes that the parties negotiating are at arm's length from each other. In other words, they have no previous relationship with each other, and therefore they negotiate as equal parties. Well, very often when businesses change hands, there is not an arm's length relationship between the parties. The seller might be selling to their children, or they may be selling to an employee or somebody else with whom they don't enjoy a completely independent relationship. And so that will lead to a situation where the final price may be different to what the valuator has determined as the fair market value. So the advice that I normally give to my clients is I provide the fair market value assessment, and I suggest to the client that they use that as a baseline and as a guide. I usually suggest that they do not share that with the potential buyer, and then they should negotiate in a way that they feel comfortable. So if their negotiating style is to ask for the moon but be prepared to come down a great deal, then feel free to do that. On the other hand, if your negotiating style is that you decide that perhaps that fair market value is exactly the price you want for the business, but you're not prepared to negotiate, then maybe ask a little bit more than fair market value and just come down a little bit. And the final piece that's allied to that is if you are selling your business, as far as possible, try and line up at least 2 potential buyers. If you only have 1 potential buyer, the likelihood is that the buyer will determine the final outcome. Whereas if you have more than 1 potential buyer, you're able to play them off against each other and control the negotiating process much more closely than if you're really only negotiating with 1 potential buyer. Okay, so in terms of what you can expect to pay a professional valuator to value your business, the size of the business typically doesn't really determine the cost of the exercise. Now, having said that, if it's a really small business, you really need to be open and frank with the business valuator and explain that it doesn't make sense to spend several $1,000s on valuing a business that might only be worth, maybe 50,000 or so. The complexity of the business is the factor that really drives the price of the valuation. And by that, what I mean is a very simple, straightforward business is usually fairly straightforward for a valuator to value and should therefore attract a lower fee than a business that has multiple revenue lines and so on. Now, it's very difficult for a professional valuator to come up with a value of a business that is well considered for much less than about $3,000. But having said that, I have done valuations where the cost of the exercise has gone well above $10,000, in some cases even $20,000. But in those cases, usually there is a very complex business and a specific reason for the amount of work that I've been doing. If the process is designed to help with a sale, then the final arbiter of the value of the business is in the negotiating process. And so the valuation only really needs to be a guide for the parties to negotiate around. In that case, you can get away with a valuation process that is perhaps more limited than, for example, I do a number of valuations where it's part of a divorce proceeding. In those cases, a judge is looking to me to come up with a specific value with no further argument. And so in those cases, I need to do a lot more work than in the case where I know that somebody is going to sell their business and it's going to be subject to a negotiating process. So I think in the sale process, you can probably expect to spend anywhere from $3,000 to maybe $7,000 or $8,000. The size of the business is not a major factor in determining that. But having said that, if you have a $700,000 business, it's probably worth spending a bit extra because in the, if you vary the value by just 5 or 10,000, you may recover the cost of the valuation exercise. Well, the risks of not getting a valuation done is that you might overlook something that is that a professional valuator would pick up on. Now, when you are selling, when you have a company that is just selling the business operations, there's a lower risk to missing something. But if, as many sellers are aiming at, the idea is to sell the shares of the company that owns the business, and this has various tax advantages, particularly the capital gains exemption advantage. In those cases, it can be very risky not to have somebody look at the balance sheet and all the operations of the company and pick up on where there may be hidden value in the business. And very often I will find that there is actually hidden value that isn't really obvious in the business, where it actually adds a bit of value to the business, and that might otherwise be missed by somebody who just feels that because their company owns a franchise restaurant, for example, as I suggested earlier, they can use industry standard multiples, and that might be okay for the business only, but there may be all kind of other assets within the company that are going to be sold with the company where there may be hidden value there that might otherwise be missed. The other thing about having a professional valuator do the work is that they are looking at the business from the outside. They can pick up on certain risks that are going to be apparent to a potential buyer, but may not be apparent to the owner of the business. Keep in mind that an owner of the business typically has run the business for 5, 10, maybe even 30 years, and they understand all the risks in the business. They've seen them all before, and they've learned how to manage those risks. And when you're looking at managing risks, you understand those risks, you see the business very differently to a buyer who comes in fresh. They don't necessarily understand the business. They see it as much more risky than the previous owner might. Now, in the eyes of the buyer in that case, the business should be worth less, because the higher the risk in the business, the less it is really worth. And that often explains the big difference in perceived value between the seller and the buyer. And so what the sellers really need to do in order to bridge this gap is to help the buyers as best they can fully understand all the risks in the business. And that may often require that the seller stays on for a fairly lengthy period in the business, working in the business alongside the buyer, in order that the buyer can fully grasp all the risks in the business. It's not just about managing the customer list and introducing the new buyer to all the customers. There's a lot more to it. And so the better the seller can do at educating the buyer on what it takes to run the business, how to understand and manage the risks, the better the seller's chances are of achieving the price that they want. Okay, so from start to finish, the length of time that a valuation process might take, typically I normally suggest 3 to 4 weeks from the time that I receive all the information. The wild card is that very often we think we've got all the information, and then partway through the process in analyzing the balance sheet or the income statement, we realize that actually there are a few more things that we really need. But I think if people looking to have their businesses valued allow for, let's just say, a month, provided the valuator isn't too busy, that usually should be long enough. And normally, if you explain to the valuator what your timelines are, and provided they're not unrealistic, I think most valuators will be able to work with whoever's needing the business valued to make sure their timelines are met.